Margins can move as fast as headlines. Since Operation Epic Fury began in Iran, 2026 projected operating margins for both corn and soybeans have changed. Operation Epic Fury and related military operations in the Middle East have led to supply reductions in crude oil, natural gas, and fertilizers, all of which impact farmers. This has led to significant volatility in both commodity prices and input prices. This volatility creates risk, but also opportunity. On one side, these disruptions have caused a noticeable increase in a variety of ag-related inputs. Those prices have gone up between 4 and 60% through the week ending March 13th, with anhydrous or urea up at least 25 to 35%, and diesel up at least $1 per gallon. Commodity prices have also risen through the week ending March 13th, with some of those gains being erased more recently. Corn and soybean futures were both up about 6% from pre-war levels, but have given back half or more of those gains recently as of March 16th. The combination of these two factors, higher input costs and current crop prices, are what matter for farmers. Let's take a look at how projected margins have changed. For corn, amongst the volatility, projected margins were higher through March 13th and were above both pre-war levels and recent lows following the January WASDE. Lower prices to begin the week of March 16th have erased part of those gains. The blue lines here show a margin estimate for a farmer with minimal inputs pre-purchased and where no crop was priced ahead. The green line is a farmer who had all inputs bought before military action started and no crop priced ahead. The orange line is a farmer who had already priced their expected production for 2026 between October and December, but did not pre-purchase inputs. These three cases highlight the range of outcomes possible from the current volatility. For soybeans, higher energy and fertilizer prices don't factor into input costs as significantly as they do for corn. So if you hadn't already priced your soybeans before March 3rd, the recent price rally had improved your projected operating margin. The relative margin between corn and soybeans has experienced an increase in volatility since the war started, but has returned to similar spreads seen through parts of February. This suggests, at least for now, there is not likely to be large shifts in acreage relative to pre-war expectations. One major exception to this would be the case where certain inputs become unavailable. Here are the likely outcomes resulting from the war. For those who purchased most of their fertilizer and fuel prior to March 1st, this run-up in grain prices has likely improved projected operating margins. For those buying inputs now and who do something to lock in prices or protect margins now, current average margins for both corn and soybeans are similar still to where they were a month ago. The worst case scenario, and one that I hope this video helps farmers avoid, is where higher priced inputs are purchased now, but some price risk is not taken off the table. The war resolves enough to lower energy and fertilizer prices, and grain prices retreat, squeezing margins. The window of opportunity that this volatility has created may be short-lived if the war resolves in just a few weeks' time, or longer-lived if these energy and fertilizer supply disruptions persist. Right now, I encourage everyone to rerun their 2026 margin projections based on current prices and your cost of inputs, and consider if it makes sense to protect some downside price risk in the event that grain prices move lower. Don't forget there are other factors that could influence these prices too, including upcoming trade talks, the South American crop, and weather in the US. We will have more to say on these markets and what to expect ahead in our next quarterly outlooks, available online in just a few weeks. In the meantime, pay attention to the happenings in both grain and input markets. Volatility creates risk, but it also creates opportunity. In the current environment, margins can move as fast as headlines. Stay focused on the math that works for your farm.